The state of the American economy, another rocky day on Wall Street after the Dow's dramatic 831-point drop yesterday. But are the fundamentals of the economy still strong? Joining me now on the phone is Ann Sonders. She is Charles Schwab's Senior Vice President. It is great to have you on the show today. Tell me, do you feel like something has fundamentally changed in the economy?
Well, not necessarily, but here's the thing that I think a lot of investors miss when they connect the dots between what's going on in the economy and what's going on in the stock market. And the overall theme around it, and it's something I'm fond of saying and have been saying for decades, is that when it comes to that relationship, better or worse matters more than good or bad. And investors tend to focus on the level of economic data. They look at whether it's consumer confidence or the unemployment rate or job growth, whatever the metric, and they see these high levels, they think, great, what's there to worry about? The problem is that markets tend to focus on rate of change, that second derivative move, and you are starting to see some cracks. And to kind of, highlight how this works, you can go back to, the sort of the ultimate peak in the market of March of 2000 and look at what the economic data was at that time. It was off the charts good, but that didn't prevent what became a pretty brutal bear market. I'm not saying this is a like period to that, but this notion that the market waits until the actual data deteriorates is not borne out by history.
When you talk about the second derivative in growth, are you talking about in GDP, where we see things up above 4%, and you don't think that there's that much acceleration beyond that? Or where specifically are you looking?
I think it's a combination of issues. I think because we have an extremely tight labor market right now, and the fact that we got massive fiscal stimulus, certainly around tax cuts, at a much later point in the cycle, we're providing that stimulus at a point where we don't have a lot of the supply to meet now this increasing demand. That's certainly the case in terms of skilled workers. In fact, most of the job gains in the last several months have come for people that have no more than a high school education, which sort of calls into question the stronger productivity down the road argument that some have been making. Consumer confidence, maybe it has more to go on the upside, but consumer confidence tends to be fairly closely linked to the stock market. So I think we could probably see a rolling over in consumer confidence if this weakness in the market continues. And then earnings growth. Earnings growth has been phenomenal this year. The problem is that the stock market is a forward-looking mechanism. And when you get into 2019, simply because the way math works, you go into the first quarter of 2019 and you're comparing that quarter's earnings to the first quarter of 2018 when we had the first initial push as a result of tax reform. The math just doesn't allow you to continue to compound earnings at above 20%. So you're back into single digits.
Okay.
So those are just examples of things where even though at that point, we're not in dire straits in terms of the level of economic data, but the market tends to sniff out inflection points.
No, I totally hear you, and I just want to, before we run out of time, I want to have a chance to try and poke a few holes in there. Talk to me a little bit about, you said the increasing productivity, that already everybody's back in the market who has above a high school diploma, but the way that we're seeing more expansion is through the idea of more automation, more robots. That doesn't lead to more productivity in your mind?
That's a longer-term benefit to productivity. Actual human workers tends to provide the shorter-term boost to productivity. And we have seen a little bit of a pickup in productivity. And I think that's probably more on the technology side than it is on the human side. But again, as we get into this incredibly tight labor market, it's harder to find the type of workers that allow more traditional measures of non-farm productivity to accelerate from here.
When you talk about
if I'm wrong and we get a significant productivity boost, that's best case scenario. It's best case scenario for the market, for the economy. It probably takes pressure off the Fed. It keeps inflation in check. So, I hope we get it. I just think it's going to be harder given the tightness of the labor market.
When you talk about places where we might have pockets where we could see the acceleration or the second derivative, as you talked about, you look at what's going on with trade around the world and the potential trade war, the trade skirmish that we're in. If we do end up getting better deals, as it has happened here in North America, doesn't that provide another place where you could see better than average growth or better than expected growth?
I just don't think we are on a path at this stage of the game with China like we were with Mexico and Canada. I also think that China has ways to combat us in this so-called trade war that go well beyond tariffs. They don't have the ammunition from a tariffs perspective to come at us, but they have other forms of ammunition. I think the reason why the market got a little bit of a lift today was the hope on the talk announced between Trump and Xi. But the problem is if we don't have anything sort of near term in terms of a resolution to this, I think we're starting to see it. I think yesterday's weakness had a lot to do with a fairly decent number of companies coming out and actually starting to put hard data and figures on what the tariffs so far mean to whether it's their capital spending plans or their near-term earnings outlook. You're starting to see it actually filter into the data now, or at least the forward guidance from a corporate perspective. So earnings are going to still be strong, but if you have more and more companies saying, hey, this is a problem, we may hold off on CapEx, or here's how it's going to hurt us in terms of profit margins, I just think the market has not yet priced that in, and I think yesterday was a reflection of that.
Liz Ann Sonders, always brilliant. Thank you for coming on. We appreciate your insight.